Hi, I'm Jimmy. In this video, we're going to look at an interesting line item on the balance sheet called retained earnings. Retained earnings can be found in the equity section of the balance sheet. So we're going to look at what it is, what it means, and how we as investors can use it and how it can help us make more informed investment decisions. So basically, retained earnings is the portion of the company's profits that are kept or retained. And it's a cumulative number. It's a number that adds up from year to year. These earnings are typically used to reinvest in the business, to pay off debt, or save for the future needs of the company. Okay, so this is the basic formula for retained earnings. And basically what we do is we take starting period retained earnings, so the retained earnings from the previous period, and then we add net income, and then we take away any dividends paid to investors. That could be cash dividends or could be stock dividends. Now, if you learned about retained earnings or what retained earnings is in school, well, you might have come across this exact formula. This is, let's call it the academic way of calculating retained earnings. But in practice, it can sometimes shake out a bit differently. So the accounting rules allow for companies to have some flexibility with how they come up with retained earnings. But the important point to remember is that if they do deviate from this core formula, well, in their financial reports, they're going to map out what formula they actually used. To illustrate, Microsoft also includes stock buybacks within their formula for calculating retained earnings. So this is what the updated formula looks like, doing it how Microsoft does it. And when we jump over to the Investors Grow website and grab their annual report, well, within their annual report, we can find this table. And when we zoom in on their retained earnings section within that table, we can see this formula in action. They take starting retained earnings from the previous year, they add net income, they take away cash dividends, and common stock repurchased. Repurchased is another name for stock buybacks. And if we think about this adjustment, it sort of makes sense. We add net income, which is profit. Then we take away any payments made to help investors. That could be dividends, or in theory, stock buybacks also help investors. So this formula makes a lot of sense. Now, if we look at another company like General Motors, well, GM also includes stock-based compensation within their calculation. So this is another possibility. And when we jump overseas to a company like Shell, which is an overseas company reporting under IFRS, well, they do something very similar to both GM and Microsoft. So there's many changes that many companies make no matter where they are in the world. Okay, so let's take a quick look at one other thing we should know about how retained earnings are actually used in practice. For this, we're going to jump back to Microsoft. Okay, so this is the table that Microsoft gave us when they were calculating their 2023 retained earnings. Now, each of these numbers are numbers that we can find in Microsoft's financial statements. But check out what happens when we go get them. So the first two, the starting balance for retained earnings and net income, they line up perfectly. Those are exactly the exact numbers you're going to find on both the income statement and the previous year's balance sheet. So to get these other two numbers, we're going to jump over to the Investors Grow website and go over to the cash flow statement. And the two numbers that we need are actually right down here. So to make this a little bit simpler, let's grab those numbers and move them back to our table so we can sort of see them side by side. Okay, now let's move these numbers up next to their respective numbers so we can compare them. And right away, we might look at these numbers and see that the numbers we got from the cash flow statement don't line up with the numbers within Microsoft's own calculation for retained earnings. Now, I know what you're thinking. Jimmy, perhaps the Investors Grow website is wrong. Well, don't worry, we double-checked everything. And when we check Microsoft's actual annual report, well, these two numbers right here are the numbers that are actually in Microsoft's annual report. These numbers line up exactly with what's on the Investors Grow website on the cash flow statement within the Investors Grow website. So these differences are supposed to be there. So this brings us to the question, why don't these numbers line up exactly like we might expect them to? And there's actually a few logical reasons why these deviations might happen. First off, on the cash flow statement, well, we're looking at actual movements in cash, where retained earnings uses accrual accounting. So if, for example, a dividend payment is declared during a period, well, that would be accounted for in retained earnings, but they don't count it on the cash flow statement until the cash is actually paid out. It could also be something like currency adjustments. That could also affect how one statement handles it versus the other statement. It's also possible that some stock repurchases get classified in one way in the cash flow statement and differently on the balance sheet with the retained earnings numbers. So much like dividends, it's possible that stock buybacks or stock repurchases The timing can be a bit different between the balance sheet and the cash flow statement, which would explain why these numbers aren't necessarily going to line up like you might have expected to if you used just the basic formula that we originally learned in school. So as we can see, the numbers can vary a decent amount from one company to another company, even within the same industry, and even between different financial statements within the same company. But even with that being true, this does not necessarily make retained earnings a useless number. To illustrate how we can use this number, here's a chart of Microsoft's historical retained earnings. Now we can see that they've steadily increased retained earnings over the number of years, over the past decade or so. And basically, this tells us that the company has earned steady profits and have largely kept those profits in-house. Oftentimes, this is a sign of a strong core business. But what about a company that was paying too much by the way of dividends, and they also had some unusual business events? Well, for that, we're going to jump over to the AT&T chart, the historical chart found on the Investors Go website for retained earnings for AT&T. And we can see that this chart looks drastically different than what we saw on Microsoft. So first, we can see that there was a big drop back in 2020. Well, in 2020, AT&T had a net income loss of about $5 billion. Plus, they paid about $15 billion in dividends. And clearly, we could see that in the chart on retained earnings. They were clearly paying out too much by the way of dividends, so there was a big drop in retained earnings. Then, in 2022, we can see that the retained earnings dropped by about $60 billion. This drop happened mostly because AT&T spun off their Warner Media division. And when they spun it off, they moved some debt off their balance sheet, and retained earnings took a big hit as well. Plus, they had a loss on the income statement of about $8.5 billion for that year. So that drove AT&T's retained earnings negative. Now, if anybody has seen videos I've done on AT&T in the recent years, well, you might also know that AT&T at that same time reduced their dividend. And personally, I think that was a much needed move for them to make. Now, since then, partially thanks to their reduced dividend, retained earnings is starting to move once again in the right direction. And if we're investors in AT&T stock like I am, well, I think that this is a good sign. But we do want to continue to watch to make sure that this number keeps going in the right direction. Now, if you want to sign up to get access to the Investors Go website, where we try to make it easier to value companies, and we also make all of these charts available for nearly every line item to try to make it quicker and easy to analyze company and hopefully make better investment decisions. Well, we got a link right here. We got a link in the description below. And thank you so much for sticking with me all the way to the end of the video. I really do appreciate it. Thank you, and I'll see you in the next video.